studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
In this section, we move away from payroll and employment insurance and look at a valuable tax planning opportunity available to many employers. Under the CRA's administrative policy, employers can provide certain non-cash gifts to employees without creating a taxable benefit, provided the applicable conditions are met. The first point to understand is that this rule applies only to non-cash gifts. A non-cash gift is a tangible item that has value, but is not money. Examples include a gift basket, a watch, flowers, electronics, artwork, or a holiday gift hamper. These types of gifts are generally considered property rather than cash. The CRA's administrative policy allows employers to provide eligible non-cash gifts with a value of up to $500 per employee each year, without the employee being taxed on the benefit, assuming all of the policy conditions are satisfied. This makes the rule an excellent way for businesses to recognize and reward employees in a tax-efficient manner. However, it is equally important to understand what does not qualify. Cash is never considered a non-cash gift. A check, payroll bonus, bank transfer, or any other payment that can easily be converted into money is treated as cash. Similarly, gift cards that function like cash or can generally be used anywhere are often treated differently because they resemble cash equivalents rather than tangible property. These items may result in a taxable benefit depending on the circumstances and the applicable CRA guidance. Notice how the form of the gift is just as important as its value. Two gifts worth exactly the same amount may receive completely different tax treatment simply because one is tangible property, while the other is cash or a cash equivalent. This distinction is one of the most common areas where employers make mistakes. When the employer provides an eligible non-cash gift within the CRA's policy, the process is straightforward. The employer purchases the gift, maintains appropriate records, provides it to the employee, and the employee generally receives the benefit without additional taxable income. At the same time, the employer can generally deduct the cost of the gift as a business expense, subject to the normal tax rules. To administer this policy properly, good record keeping is essential. The employer should maintain invoices for the gifts, document the value of each item, record who received the gift, and keep evidence showing when and why it was provided. These records help support the tax treatment if the CRA ever reviews the file. This policy can also apply to owner-managers who are employees of their own corporations, provided the requirements are met and the gift is given in the employee capacity rather than simply because of share ownership. As with many owner-manager situations, the facts and circumstances should always be reviewed carefully. The key lesson from this slide is that a properly structured non-cash gift can be an excellent tax planning tool. It allows employers to recognize employees, improve morale, and provide meaningful benefits without necessarily creating taxable income. The most important rule to remember is simple. The benefit must be a genuine non-cash gift that satisfies the CRA's administrative policy. Now that we understand the basic $500 non-cash gift rule, the next step is learning which gifts qualify under the CRA's administrative policy and which ones do not. This distinction is extremely important because two gifts of exactly the same value can receive completely different tax treatment depending on their form. Let's begin with gifts that are generally eligible. These are non-cash items that have tangible value and are given directly to the employee. Examples include gift baskets, flowers, books, tablets, and other electronics, coffee machines, artwork, sports equipment, and holiday hampers. These are all examples of physical property rather than money. When they satisfy the CRA's conditions and remain within the applicable limits, they are generally treated as non-taxable employee gifts. Now let's compare those with gifts that are usually not eligible. Cash is always treated differently because money itself is a taxable benefit. The same principle applies to checks, payroll bonuses, bank transfers, and other direct cash payments. Even though these items may be intended as gifts, they are considered compensation rather than non-cash property. Another important category involves cash equivalents. Some gift cards function almost like cash because they can be used almost anywhere or easily converted into money, depending on the facts and the CRA's administrative policy. These types of gift cards may not qualify for the non-cash gift exemption and could create a taxable benefit. This is why employers should review the CRA guidance carefully before providing gift cards as employee gifts. A useful way to analyze every gift is by following a simple decision process. First, ask whether the gift is cash. If the answer is yes, it will generally create a taxable benefit. If the answer is no, determine whether it is genuine non-cash property. If it is tangible property, the next step is to verify that it satisfies the CRA's administrative policy. If all of the requirements are met, the gift will generally be treated as a non-taxable benefit. If the policy requirements are not satisfied, the gift may become taxable. One of the most common mistakes employers make is focusing only on the dollar value of the gift. The value certainly matters, but the form of the gift is equally important. A $500 gift basket and a $500 cash payment may have the same economic value, yet they can receive very different tax treatment because one is tangible property while the other is cash. For this reason, professional accountants always review both the value and the nature of the gift before determining its tax treatment. Proper planning at this stage helps avoid unexpected payroll adjustments and ensures the corporation remains compliant with CRA requirements. The key takeaway from this slide is simple. A qualifying non-cash gift can often be provided on a tax-efficient basis, while cash and many cash-equivalent gifts generally create taxable benefits. Before giving any employee gift, always ask two questions. What is the value of the gift? And just as importantly, what is the form of the gift? Both answers determine the correct tax treatment. This final slide shows how employers can use the CRA's non-cash gift policy as a practical tax planning strategy. Rather than simply giving bonuses through payroll, businesses can recognize employees in a way that rewards them while also improving tax efficiency for both the employer and the employee. The planning process begins by deciding which employees will receive gifts. Employers often use non-cash gifts to recognize long service, outstanding performance, special achievements, holidays, or other important occasions. The goal is to reward employees for their contributions while remaining within the CRA's administrative policy. Once the recipients have been selected, the next step is choosing appropriate non-cash gifts. The gifts should be tangible items such as gift baskets, electronics, flowers, artwork, or other physical property. At this stage, employers should avoid selecting cash or cash-equivalent items that may create taxable benefits. Before purchasing the gifts, it is good practice to confirm that the proposed gifts satisfy the CRA's requirements. Reviewing the administrative policy in advance helps prevent unexpected payroll issues later and ensures that the gifts qualify for the intended tax treatment. After the gifts are purchased, proper documentation becomes essential. Employers should retain invoices, record the value of each gift, identify who received it, and document the date and reason the gift was provided. Good records make it much easier to support the tax treatment if the CRA ever reviews the corporation's payroll records. Once everything has been documented, the gifts can be presented to employees as a meaningful form of appreciation. When structured correctly, the employee receives valuable recognition without generally having to report additional taxable income, while the employer can generally deduct the cost as a business expense, subject to the normal tax rules. Beyond the tax savings, non-cash gifts provide several business benefits. Employees feel recognized and appreciated. Workplace morale often improves, and businesses can strengthen employee retention. At the same time, employers avoid unnecessary payroll deductions that would normally apply to cash bonuses. However, several common mistakes should always be avoided. Do not replace gifts with cash payments or payroll bonuses if the intention is to use the non-cash gift policy. Avoid gift cards or other items that function like cash unless you have confirmed their treatment under the current CRA guidance. Poor documentation, missing invoices, or failing to track annual gifts can also create unnecessary problems during a payroll review. A good compliance process includes maintaining a checklist throughout the year. Track the value of gifts provided to each employee. Keep all invoices and receipts. Record the recipients. Review the CRA policy periodically for any updates. Consult a CPA whenever there is uncertainty. And maintain organized payroll and employee records. For owner-managed corporations, this planning opportunity can be especially valuable. An owner-manager who is also an employee of the corporation may, in appropriate circumstances, benefit from the same administrative policy when all of the CRA requirements are satisfied. As always, the benefit should be provided in the individual's capacity as an employee rather than simply because they are a shareholder. The key takeaway from this section is that employee appreciation and tax planning can work together. By carefully selecting qualifying non-cash gifts, maintaining proper documentation, and following the CRA's administrative policy, employers can reward employees in a meaningful way while achieving an efficient tax outcome. Good planning transforms a simple employee gift into a valuable tax planning opportunity for both the employer and the employee.